Good evening. My name is Otis Thrick Jr., Director of Chapter Member Services for 100 Black Men of America. Welcome to our financial webinar today, hosted by the 100 Black Men of America, a guide to the markets investing in a pandemic recovery, sponsored today by JP Morgan Asset Management. From Jordan Jackson, Vice President, Global Market Strategist, JP Morgan Asset Management. Before you hear from Jordan, we would like to play a short video by JP Morgan. Again, thank you and welcome.
For far too long, systemic inequities have hindered the Black community's ability to build generational wealth.
Advancing Black Pathways was created to address these systemic challenges and strengthen the economic foundation of Black communities. We're focused on doing this through our 4 impact pillars. By investing in Black-owned businesses, we're creating more jobs and opportunities. We also want to help people improve their financial health and increase access to banking in Black communities. Homeownership is also critical, and we're providing tools, resources, and networks to make the dream a reality. We're committed to creating an ecosystem of support to help Black students and professionals thrive in the workplace.
At JP Morgan Chase, we recognize the responsibility we have to break down structural barriers.
This work can't be done alone. We need a collective action to bring about sustainable change, because we know that when we all get an equal slice of the pie, we all win.
Good afternoon, everyone. Very excited to be here. My name is Jordan Jackson, Global Market Strategist here at JP Morgan Asset Management. And again, I'm very excited to be here this evening. And thank you all for taking your time out of your Wednesday evening at 6 o'clock to join us here today. Just a little bit about myself. Graduated from the University of Virginia in 2015. Immediately started my career at JP Morgan Asset Management. My first role, I was on the consultant relations group, so facing off with institutional consulting firms in positioning JP Morgan's products and strategies with institutional consultants that they then would go and position those products with their institutional clientele. So that gave me a little bit of insight into how institutions invest their capital and the access to different assets that they have access to. I then moved over to the Market Insights Group, the team that I'm currently on, as an analyst, really focusing in on macroeconomic research. So looking at the macroeconomic environment, anything from inflation to monetary policy to equity market valuations, and being able to dig underneath the hood to try to find out what's going on and how investors can sort of change their allocations or tweak their allocations in order for them to generate those returns and meet those investment goals that they're looking for. So I've been doing that for the better part of the last 4 years now. And more recently, I've been able to sort of be on the road a lot more, traveling, meeting with clients. Well, not necessarily not very much in the past 2 years, but meeting with clients, meeting with investors, financial advisors, and just talking about the financial landscape that we're currently in, and the investment opportunities that they're currently providing investors. So within this allows me to sort of have several media appearances, do conferences. I was on Yahoo TV this morning and was able to be on Bloomberg this past Monday. So really enjoy just communicating what's going on with the world around us, the macroeconomy, and how that plays into the investment decisions for our institutional investors, as well as our end clients. So I'm very excited to be here today, this evening, with you all to sort of, we're going to cover a lot. We're going to hit on a lot of different topics. But in terms of the agenda items that I'd like to cover, first, having a plan, a financial plan. We'll walk through some of the building blocks of having a very strong foundation for financial planning for the future. We'll talk a little about the cash environment, right? So cash not generating too much for the portfolio is actually being a drag on the overall portfolio. So we want to be careful that we don't have too much cash on the sidelines. We'll talk about the importance of investing early and often. We'll look at 4 different scenarios of people who have either started late or started early and finished too soon, So we'll talk a little about the benefits of being consistent with your investing and investing early as possible. We'll talk about diversification, right? You don't diversify your portfolio because you think you can cobble together the best performing assets in a given year. You diversify the portfolio because when one part of the portfolio zigs, you want the other part to zag. And that really helps to lower volatility of returns in the portfolio and generally just provide a smoother ride for investors. We'll put volatility in context. We do expect volatility to sort of pick up or market gyrations to pick up in the months ahead. So we'll talk a little about how that's a normal occurrence, and we shouldn't, as investors, we really shouldn't overreact to those volatile moments. We'll talk about our opportunities in today's markets, where we're seeing opportunities. I'll say we're still seeing opportunities in U.S. equity markets, but we're starting to see more signs that international markets can be providing pretty good sources of returns, future returns going forward. And then we'll talk a little about the challenges that we're seeing in the bond market or the fixed income space more broadly. We'll talk about ETFs and mutual funds. So the difference, you probably heard those two names before. So the difference between those two vehicles and accessing your investments. And then lastly, I want to just wrap up with sort of 3 resources that I think everyone can use after this call immediately to start making those investment decisions and putting those financial plans in place. So with that, I will say before we jump into this, I am not a retirement specialist or a social security specialist. And so while some of my comments may touch on the retirement side of things, I imagine as questions come in, I'll try to fill them as best as I can. But in the event that I can't, specifically on the retirement side of things, we'll be happy to take those questions and funnel them to our retirement specialists. So jumping right into things. Here, I think this is a great slide to just sort of level set and providing sort of those building blocks that we should begin thinking about within our financial plan. And these are really the building blocks for long-term successful financial planning in our view. So first, we still very much believe that you're going to want to have roughly 3 to 6 months of emergency savings. That's the first part there to the bottom right. Again, these are rent, utilities, bills. If you have dependents, making sure that they're taken care of. You want to have 3 to 6 months put away just in case something happens or you lose your job or you're maybe in transition looking for another job, that you're still able to operate normally, at least for a 3 to 6 month window. So again, very, very important that you want to have that capital readily available. It should be in a savings account, nothing where it's sort of tied up or locked up for a certain amount of time. Again, you want to have those funds readily available. The second is really the second and third sort of grouped together is you want to begin contributing to, especially if you have an employer plan, defined contribution, and your health savings account. These are elements in which, right, for retirement, 401k plan, particularly if you have an employer that's willing to match, double the contributions that you're willing to put into the plan, that really goes a long way in helping to, be comfortable as you start to near and reach retirement. So I remember when I first started working, again, it was really about getting that reserve fund, that 3 to 6 month savings. Then it was about establishing how much I felt comfortable contributing to my JP Morgan defined contribution plan. So those are really the first 2 things that I did when I first started working professionally. Number 4, paying down high interest loans. Many of us may have graduated undergrad, master's degrees, and are sitting on a decent amount of student loans. Now, me included, graduated from the University of Virginia with roughly about $100,000 in student loans. So I'm still paying those back for sure. But one of the things that I did as soon as I graduated was I had roughly about 8 different student loans outstanding, all with varying different interest rates. And what I did was I combined those student loans into one loan at a much lower interest rate. And what that allowed me to do is, one, it brought my monthly payments down on those loans. And so, I could do a little bit more with an increase in my disposable income. It also even shortened the life of how much or how long I was going to have to pay down on those loans. And really the key, getting that interest rate as low as possible on any sort of loans that you have, is because if you think about it, right, if you can take the money that you would take out on a loan and potentially invest that at a higher rate, it's pretty hard for us to feel confident, in those loans that are generating 6-7% in interest per year, that you'll be able to consistently generate returns in the investment market that's going to outpace the interest that you're going to be charged on those loans. And so for that reason, it's really, really important for, again, after you've established that reserve fund, after you've begun contributing to an HSA or defined contribution account, that you want to start paying down, if that's the case, if that's your financial situation, you want to start to pay down those high interest student loans at first, and potentially consolidate if you have a number of loans that are out there floating around. Now, I will say numbers 5 through 8, obviously, depending on your situation, whether you want to continue to contribute more to your defined contribution plan or to that HSA, or to pay down those lower interest loans, I'll say that I think you can do numbers 5 through 8 while investing as well. And that's really the key that I want to mention there. Again, these are great sort of steps to continue to take. Again, maximizing that defined contribution, paying down additional loans with those lower interest rates, maybe establishing a separate account from that defined contribution plan, so an IRA account of sorts. But generally speaking, I think you can do all of those things while also investing, and that's that taxable account at the end. So again, these are just some of the building blocks that we think are critically important for great financial success down the road. I want to talk a little bit about cash, the detriment that cash can be to the overall portfolio. Now, I mentioned you want to have roughly 3 to 6 months of reserves funds tucked away. Again, though, that's your emergency fund. That's in case things go wrong. But having too much cash is really going to be an overall drag on the portfolio. So what we're showing here on this slide is we're bucketing it by decade, but we're just looking at the return. Those gray bars are the annualized return over these different decades that you were able to generate, or the income that you were able to generate on a 6-month CD or a 6-month certificate of deposit. Many major banks offer these CDs, but they're designed to be sort of your cash-like equivalent, where you would just lock up your money for 6 months' time, and you would get some level of interest rate that the bank is willing to pay you, but by investing your capital, your cash, into that CD. Now, historically, you were able to get really, really high interest income by just parking your money in a 6-month CD. So in the 1980s, the average annualized return that you were able to get by just parking your money in cash was roughly about 10%. So said another way, if you invested $10,000 into a 6-month CD at 10%, you would be receiving every year roughly about $1,000 in interest income. Now, that was outpacing back then in the 80s. That would outpace the rate of overall inflation, which we show in the blue bars, the rate of education inflation. So if you think about things like tuition, room and board, medical inflation, as well as housing inflation. Obviously, home prices being a big component of wealth for many of everyday Americans. But again, you would be able to just park your money in cash, 30 years ago, 40 years ago, and you'd be able to have that cash grow and outpace a lot of these big ticket items. But if you fast forward to today, for example, 2020, if you look at that gray bar there, if you were to just park that same $10,000 today into a 6-month CD, where in the 80s you were getting $1,000 in interest income per year, you're now getting $40 in interest income per year. And you can see, just based off of that gray dashed line on the page as well, that is grossly underperforming overall inflation, housing inflation, medical inflation, all these big ticket items that we know we are going to have to save for down the road. And just to bring this chart to life a bit, let's think about education inflation, for example. Let's just say, obviously, with education inflation, you're gradually investing for your kids' education over, say, a 18 to 20-year period. So if we take the time period from the 2000s to the 2000s and the 2010s, right? You've got a 3.3 average annualized inflation of 6-month CD. And then in the 2010s, that changed dramatically to about 0.5% annualized interest income on a 6-month CD. So let's just say on average, over that 20-year period, the interest income you were able to generate on $10,000 was roughly around 2.5%, 2 to 2.5% over the course of that 20-year period. Now let's look at education inflation. We see that over the 2000s, education inflation was running at roughly 7%. Then the 2010s was running roughly about 4%. So let's just say on average, over that 20-year period, education inflation was rising by about 5.5%. Now, for simplicity's sake, let's just say January 1st, 2000, tuition or education costs $10,000. You also began saving for your child's education of $10,000 on January 1st, 2000. Now, at 2.5% on average that you would be able to receive on that 6-month CD by sitting in cash, that $10,000 at the end of 2019 would have grown to just $16,900. Now, education inflation, if you were that same $10,000 of what that tuition had cost in 2000, that number at the end of 2019 is closer to 30,000. So again, over this 20-year period, while the intention, of course, is to invest into your child's education, the fact that education expenses were rising at a much, much faster rate than what you were able to earn on cash, it's just that much more important as to why you want your cash to work harder for you. It's just not going to where interest rates are today and where we expect interest rates to be. We don't expect this environment to change, and we don't expect investors to be able to generate any sort of meaningful interest income just by sitting in cash. So again, it's increasingly important that we get invested, that we stay invested, and that we continue to invest as often and as early as possible so that we can reach those goals that we're looking to achieve down the road. Now, to get into really the importance of getting invested early and often, talking about those 4 different scenarios that I had mentioned at the outset. If we look, first we start with Nervous Noah at the bottom left of this page. So Nervous Noah, he invests for a full 40-year period from age 25 to 65, but he only invests in cash. Now, this is a pretty generous assumption because he's earning about 1.1% on cash. I just highlighted on the recent slide that we're actually getting less than 1% sitting in cash. But he continues to make those contributions into that cash investment over the 40-year period. Well, you can see that in hard dollars, he invested a total of $96,000, or he took $96,000 of his own cash over the course of that 40 years, and that only grew by the time he was ready to retire to $121,000. He only received off of that whole overall portfolio, only 21% of that balance is attributable to an investment return, or that 1.1%. Right, so that's just not going to cut it. While he did invest often and early, he invested in cash. And again, this is just another point as to why we need to get off the sidelines and get our cash invested. Now, Quincy, invests from ages 25 to 35, so for a 10-year period. But he's not investing in cash. He's invested in a diversified portfolio that's able to return roughly 5.75% annualized over that period. So if you look at the gray line, you can see that even though he invested for 10 years versus Nervous Noah that invested for 40 years, he was able to generate a better end return of $176,900 when he only invested actual hard dollars of $24,000. And that's because when you think about getting invested early, your money has more time to compound later on in life, right? And so the fact that he was investing early through the first 10 years, that allowed him to have a better overall ending portfolio balance than Nervous Noah. So let's take a look at late Lila. She invests from age 35 to 65. So for a 30-year period, again, earning 5.75% on that investment. She contributed hard dollars around $72,000. But again, because she started 10 years late or later than Quincy, then she didn't have as much benefit of compounding over time. So while she may have performed slightly better, remember she had been investing for 20 more years than Quitter Quincy. Yet that portfolio balances is roughly the same, more or less, at 192,000, with 63% of her investment coming from portfolio return. Now look at that final portfolio. Consistent Chloe making consistent investments over her 25 over from 25 to 65, so over a 40-year period, earning that 5.75 annualized return on her investment. Look how drastically different her portfolio performed, or her retirement balance would be at the end when she's ready to retire. Again, $368,000, $368,900 for that ending portfolio, and 75% of that portfolio, again, coming from return, coming from compounding. And so this is really just a great way to sort of illustrate the benefits of investing early and investing consistently in order to reach those retirement goals. Again, we don't want to be sitting in cash, but we certainly want to be consistently investing over time. This is another sort of a visual highlighting the benefits of consistent contributions and how they'll compound themselves over time. And this is just looking at the period starting from the global financial crisis back in 2007. What we're showing, the green line is just showing the portfolio of roughly $10,000, how $10,000 performed if that was invested in the S&P 500 in green, if you invested in a 60-40 stock bond portfolio in light blue, and then in dark blue if you were making $200 monthly contributions with that $10,000 starting balance. You can see a couple things that I would take away from this slide. First, diversification. If you look at that 60-40 stock bond, whether you are making monthly contributions or not, your drawdown during the financial crisis was much less than if you were only holding equities. And so this is why investors tend to own some sort of mix of stocks as well as bonds. The second point that I would make, that diversification component and that consistent contribution piece really helps to allow that portfolio to recover a lot faster. Take a look at, it took roughly about 4 years for that $10,000 to recover back to even if you were only invested in US equity markets or the S&P 500. But while it took 4 years for that stock portfolio to recover, it only took about 2.5 years for that 60-40 to recover. So again, it's pretty impactful when you think about consistent contributions and how they can help compound over time. You can see that, you know, that 60-40 stock bond with monthly contributions, even today, has a much larger balance of around $339,000, $340,000 relative to that static 60-40 stock bond, which that money has grown to about $274,000. So again, another visual just to show the benefits again of consistent contributions and how they can compound and provide better returns over time. On that point on diversification, right? I mentioned earlier, you don't diversify your portfolio because you think you can, you know, pick the right asset class in a given year. You diversify because when one part of the portfolio zigs, the other part zags. And that's one of the reasons why when you look at the asset allocation portfolio, it's always in the middle of this page. It's never at the top of the page. It's never at the bottom. It's always hovering right around the middle. And so a well-diversified portfolio is going to allow for a better investment experience, a better investment ride over the long term than making any one single allocation. So the way to read this chart, this is just calendar year returns for individual asset classes. We've got large caps, we have small caps, we've got a little bit of high yield and emerging market equity as well. And that asset allocation is a diversified portfolio. We show the percentage breakdowns of what that portfolio actually looks like here in the footnotes. But you can see again that portfolio is never at the top. It's never the best performer in a year. It's never the worst performer in a year. It's always hovering right around the middle. If you look at the far right-hand side of this page, you can see that annualized return on that diversified portfolio delivered 6.7%. If you think about a lot of the analysis that we're suggesting is you really want to be having returns, you know, north of 5.75%, for us to consider it to be, you know, pretty good year. And then you look at that volatility to the far right-hand side of 11.8%, one of the lowest volatility out of all the different individual asset classes. In fact, that diversified portfolio has a lower volatility than all other asset classes other than just bonds, fixed income, and cash, right? So again, it's really about the experience, it's about the ride, and that's why you want to diversify across a broad swath of different assets and asset classes, and not overweight your portfolio to any one specific asset class. Now, this doesn't mean you can make tactical shifts given the macro environment. And when I say tactical, I mean short term, sort of a 3 to 6 month view, if you will. If you expect small caps to outperform in the short term, it doesn't mean you shouldn't overweight small caps within the portfolio. It just means that you don't want to abandon large caps altogether. And that's the argument that we're making here. Next, I want to put volatility in context. This is a great slide from our Guide to the Markets publication that I think effectively communicates that message. What we're showing here is the gray bars are the calendar year returns on the S&P 500. Now, those red dots are the largest intra-year decline in the market for a given calendar year. So the largest drop in a given calendar year when the market hits a peak, and then the largest decline that you've seen in that year. On average, we over the last since 1980, on average, the market corrects by about 14% per year. And so we oftentimes hear the Dow fell 300, 400, 500 points. That's very, very normal. In fact, that's a mini correction, if anything. Again, on average, you're looking at a roughly 15% correction on the market in any given year. But encouragingly, in 31 of the last 41 years, or greater than 75% of the time, the markets have been positive. Now, again, we think volatility may pick up. If you look at the so far year to date, as of the end of October, just this past Friday, you can see the S&P 500 up 23% so far year to date, and we've had very little volatility, right? The max decline that we've seen in the market so far this year has been 5%. So with the expectation that we're still seeing fiscal stimulus negotiations being had in the White House, you're seeing a large swath of elections being hosted as well across the country. You're also seeing concerns, right, around the Delta variant and how that might impact the overall economy as well. We do think that volatility is likely to pick up as we move through the end of the year. So investors should not be surprised if you see another 5 to 10% correction in markets, because we've gone so long without having any sort of a meaningful correction. But again, to put it in context, it's very normal. It's a very normal occurrence. And we still expect markets to be positive this year, as well as a high single, low double-digit return for the markets for next year as well. Now, putting volatility in context, right? Whenever there are volatility-inducing events, you hear those headlines about the Dow selling off for a really bad day on Wall Street. That people tend to get bearish. They tend to get scared, and they want to pull their money out of the market. We absolutely think that that's what you should not be doing. And there's the data, which we present here, that backs that up. What we're showing is the performance of a $10,000 investment between January 2nd, 2001 and December 31st of 2020. So a 20-year investment horizon. Now, the bar to the far left, this shows that if you just stayed invested, if you just put that $10,000 in the market on January 2nd, 2001, and you just let it ride up until the end of last year, you would have generated about a 7.5% annualized return on the S&P 500, and that your dollar return, that $10,000 would have grown to $42,231. Now, and again, these are somewhat of an extreme scenario, but let's just say over that 20-year time period, you missed. So you traded out and got back in. You missed the 10 best days of the market performance over the past 20 years. Essentially, your return, just 10 days, your return would have been cut in half. That 7.5% return, if you have been fully invested, if you missed the 10 best days, again, that return would have been slashed in half. That $42,000 now is a cumulative return of 20,000. And so again, the reason why you don't want to necessarily try to time the market is what's highlighted in that box there. 7 of the best 10 days occurred within 2 weeks of the 10 worst days. And if you even were to move forward to a year like last year, during the throes of the pandemic, the second worst day of 2020, March 12th, was immediately followed by the second best day of the year. So again, a lot of times when markets will sell off pretty meaningfully in a given day, that's when investors are running for the hills. They're ready to get out. They think the losses are going to further compound. And in some cases they do. But if you also consider that the next best day, or the second best day in the calendar year was immediately following that worst day, you've already missed out on those returns. The challenge with timing the market is you have to get 2 things right. You have to know when to get in, and you have to know when to get out. And it's very difficult to get both of those correct. And so we were always, I deal a lot with investors that come to me and say, should I be selling out now? Should I be getting out now? It's really about, let's look at the long-term plan. We have a plan that's been put in place. We don't want to allow market volatility to cause us to get off course and to make irrational decisions like selling out of our portfolio. Now, kind of shifting gears to where we're seeing opportunities in the market. This is another slide from our Guide to the Markets publication, and we're just simply showing the S&P 500 going back over the last 25 years or so. And we also highlight sort of different valuation metrics as well in that table. And you can see that pretty much prior to the pandemic, the markets had experienced a massive run-up, a 400% return over the previous decade. Now, obviously, you've had a pretty meaningful correction. And since the low, March 23rd of 2020, markets have continued to take off, right? You're now up about 106% cumulatively since the March 23rd lows. So the question is, well, what will markets do going forward? Are we looking at another pre-pandemic decade where markets deliver 400%? Well, if I had a crystal ball, I probably would be on an island somewhere. But we do think that markets can continue to move higher from here. There are a couple reasons why we think that's the case. One, you have very, very strong earnings coming from companies, specifically large cap companies, S&P 500 type companies. So far this year, relative to last year, and obviously we recognize that last year was a bad year for earnings, but earnings are expected to grow this year by about 65% on a year-over-year basis. Now, obviously, markets are forward-looking entities, or is a forward-looking beast. So when we think about earnings growth for next year, markets earnings are expected to grow by anywhere between 8 to 10%. So still a very, very strong year in earnings. And we think that that's going to provide a pretty good support for equity markets in the year ahead. And again, that sort of informs our high single-digit, low double-digit return outlook for the S&P 500 next year. I would also say we are looking at potentially additional fiscal stimulus coming through, either through reconciliation as well as additional spending on physical infrastructure. We do think this kind of fiscal support is going to, one, continue to support consumer balance sheets, and that continue to provide a lot of strong support for consumption growth. Where do we spend our money? We spend our money at these companies, right? And that's going to continue to provide earnings growth as we move into next year as well. I would also say we continue to see a very strong improvement in the labor market. We're seeing higher wages across the economy. And so as consumers, everyday consumers are making more money, they're going to go and they're going to spend it. And so this continues to provide a lot of support in our view for equity market performance, stock performance in the years ahead. We also think that while U.S. large cap is probably very well positioned to perform well in the years ahead, we do think that international markets may be in the very, very early innings of a longer term trend of international outperformance. So here we're just looking at these cycles of equity performance, and what we're showing is when you see those green mountains, those purple mountains there. That's when developed market equities are outperforming, and this is measured by the MSCI EFA. Developed market equities are outperforming US, and when those gray mountains are rising, that's when the US market are outperforming international markets. Now you can see that over pretty much over the better part of the last 15 years or so, the U.S. has dramatically outperformed international markets. So the question then becomes, is this going to continue? And if so, what supports our view that international markets can begin to start outperforming the U.S.? Well, one, we should recognize that the very heavy weighting of technology companies in the S&P 500 and in U.S. stock indices has really helped to lead the U.S. to continue to outperform its international counterparts. But where are we at today? Are we in an environment in which the global economy is beginning to recover? The Delta variant is beginning to recede as vaccination progress really moves and expands out into the rest of the world? Yes. When we look at earnings growth, are we seeing earnings growth coming in a lot stronger in international economies than what we're seeing here in the U.S.? Yes. Do we expect the U.S. dollar, to depreciate over the next, call it 7 to 10 years? Yes. And this acts as the dollar weakening as a U.S. investor going international. The dollar weakening acts as a nice cherry on top to returns once you convert those foreign stock market performance back over into U.S. dollars. And so with all these things, being baked into our assumptions, and again, you've got this very, very long period of U.S. outperformance, we do think some of these other sectors outside of tech are now in a good position and are poised to perform particularly well, particularly those cyclical value-orientated parts of the market, right? Sectors like energy, industrials, materials. And a lot of developed economies have much greater exposure, their benchmarks have much greater exposure to those cyclical value-orientated parts of the market. And so we do think that is really going to be what sort of changes the guard, if you will, and really allow international performance to outpace that of the US. Now, we're not just equity investors necessarily. We're also bond investors as well. Those of us that invest in fixed income markets also. We do expect there to be a bit of a challenge within fixed income markets or bond markets more broadly. What we're showing on this slide is the spreads to worst across a host of different fixed income sectors. Now, what are spreads? Spreads are just simply a measure of credit risk within these different sectors of the bond market. So the higher the spread, the more credit risk is being priced in to the market. The lower or tighter the spread, the less credit risk. And credit risk is simply a measure of default. What's the risk? What's the likelihood that these companies that I'm lending to or entities are going to default? And so right now, what's being priced into markets as shown, those gray bars are the 15-year ranges. Again, we like to show as much history as possible when looking at different valuation metrics. The blue bar, the lavender bar shows the 15-year median of where spreads have been across these different sectors. And then the light blue diamond is where spreads currently are. So a way to read this chart, if that diamond is below that median bar, spreads are tight, and that means that bonds are expensive. If it's above that bar, that means spreads are not necessarily tight, and bonds are cheap and are providing a pretty attractive opportunity. So when you look at sort of on the left-hand side, if you focus on the left-hand side, a few of these sectors, U.S. Treasury markets, municipal bonds as well, investment-grade corporate bonds, mortgage-backed securities, are all trading at spreads that are extremely, extremely tight relative to history. There's not that much value that to be had or generated in portfolios by investing in these sectors. Where we are seeing opportunities is when you look at areas like emerging market debt, European high yield, European corporate high yield, U.S. high yield as well to a certain extent. These are providing higher absolute levels of yields, but they also provide a more income stream for those who are looking to invest in those parts of the market. So while some of the more core fixed income areas are certainly going to be challenged in an environment where inflation is running above trend, the real economy, economic growth is running above trend. And so because of these, interest rates should start to move higher as a result of these factors. Some of these more core parts of the fixed income market are certainly going to be challenged in the quarters ahead. And so again, we're continuing to see opportunities in areas like emerging market debt, European corporate, European high yield. But again, you really want to have active management and active managers, someone who's in those markets, being able to pick those bonds, identify good value opportunities, rather than investing in sort of a passive index. Because, and we'll get into sort of what that means exactly, because you want to know exactly what you're gaining exposure to. You don't want to gain exposure to some of the most indebted countries or markets. You want to gain exposure, at least in the bond market, to those that are providing a decent yield and have stable and sturdy balance sheets. And that's really what it's all about. I do want to mention sort of how, what are ways in which you can invest, or the vehicles, I should say, to invest. And we've all probably heard of exchange traded funds, or ETFs, versus mutual funds. And so I just wanted to talk through a little bit about sort of the differences between the two. Now, I did mention the term benchmark. You cannot invest in a benchmark. You can invest in a vehicle, an ETF or a mutual fund, that is looking to replicate that benchmark. And a benchmark is typically a basket of stocks or a basket of individual bonds. And so again, it's really about thinking about, where do you want exposure? Do I want a basket of US stocks? Do I want a basket of emerging market bonds? There are ETFs and mutual funds that allow you to have access to those different baskets or those benchmarks, depending on where you want to invest your capital. The second point that I would make is that the concept of passive versus active. The idea of a passive is simply, like I mentioned, those benchmark, that basket of, let's just say, US stocks, for an example. If it's a passive index, or a passive ETX, or a passive mutual fund, again, all that mutual fund or ETF is trying to do is to replicate the performance of the stocks in those baskets. There's not a portfolio manager. There's not someone, with a big Bloomberg monitor who is actively making decisions on what stocks should make it into that basket, or which sectors they should be overweighting or underweighting relative to the benchmark. So that's the fundamental difference between passive and active. You can have both passive and active mutual funds and ETFs. I think there's a common misconception out there that only ETFs are passive products. That's not true. ETFs can be actively managed products also. Now, let's get into the nitty gritty. What are some of the differences between ETFs and mutual funds? So first, some of the similarities: diversification. I talked about that basket, right? You're going to get a diversified basket of either stocks or bonds, depending on the ETF or mutual fund that you're investing in. Portfolio management. Now, I mentioned passive versus active. There's still a portfolio manager tied to each of these strategies, if you will. But they're not in a passive strategy. They're not actively making decisions. They're just looking to replicate the benchmark. In an active strategy, the portfolio manager is looking to overweight, underweight certain sectors. Maybe it has some flexibility to invest outside of what that specific benchmark that they're trying to outperform against. So again, there's more of an active approach, and it typically comes with higher fees, right? You'll pay someone to generate what we would call alpha in your portfolio in order to generate returns in the future. Again, both active and passive are available in ETF vehicle as well as a mutual fund vehicle, but both strategies are going to be managed by a portfolio manager. And then the third similarity is access. Again, back to that diversification. Depending on the ETF or mutual fund that you're trying to invest in, geographical diversification, sectoral diversification, style diversification, whether it's value versus growth. Again, you can have, depending on which vehicle you like, you can have access to that. You can have access to that diversification benefits in either an ETF or a mutual fund vehicle. Now, some of the differences between ETFs and mutual funds. The first is transparency. So for mutual funds, they typically will post their holdings at the end of the day, where an ETF are actively traded on an exchange, right? And so you can see in real time changes to the portfolio, changes to that basket that we talked about. And you can trade, right? You can trade intraday, that liquidity piece. ETFs trade like a stock. So let's just say, markets are there's a momentum trade happening, and markets are running up between 9:30 a.m. when markets open to 11 a.m. And you want to get on the ride because you believe that markets will continue to grind higher. Well, you can purchase an ETF. You can add to an ETF that you already own intraday. That trade won't close on a mutual fund until the opening of the next business day. So again, ETFs provide that ability to trade intraday, where mutual funds do not. And then for a tax efficiency perspective, and these are one of the big drivers of why ETF growth has continued to grow over the past decade, really, is because of these tax benefits that they provide. So not to get into the nitty gritty of it, but typically within a mutual fund context, in order for a portfolio manager to raise cash outside of being, given more cash from investors, they've got to sell their winners in order to raise cash to purchase other securities in that basket. Now the challenge is when you sell out of a security to raise cash to buy another security, that's a taxable event for mutual funds. And because of that, that's constantly happening as the portfolio manager is making different decisions. That tax liability is prorated across all the investors in the fund. And so when you've got a mutual fund holding and you get hit with that capital gains tax, or it's showing a certain percentage of capital gains that's going to be taxed on a mutual fund, that's because, again, that mutual fund is selling out of its winners in order to raise cash to purchase other opportunities that they're seeing in the market. The fundamental difference with an ETF, though, is an ETF has what they call a redemption process, and this allows for an in-kind transfer of securities within the ETF. So you're not necessarily selling a security in order to raise capital. You are transferring from owning one security to another, and that's not a taxable event, and that allows for this tax efficiency for ETF vehicles. So that's something that I did want to sort of mention in terms of what a benchmark is, how ETFs and mutual funds, you can gain access to either replicated benchmark via passive strategy, or through an active strategy, having access to that benchmark where you've got a portfolio manager that's trying to outperform. Now we are right at a 6:50, and I do want to leave some time for questions. But I really was one of the goals of this whole conversation was really a call to action. So hopefully you've got some nuggets on how to financially plan successful. You may be curious about, well, what are some next steps that I can do to get more comfortable with making that jump in investing, and maybe even talk to an advisor about investing. So first, there are two resources that I want to share with everyone on this call. And these are more of your resources that I would pull together based off of my research. What's going on with Fed policy, what's happening with oil prices, just to give you sort of a broader sense of what's going on with the world. So that first resource is the JP Morgan On the Minds of Investors blog. So if you just go into Google and type JP Morgan On the Minds of Investors, you'll be able to pull up a series of blog posts, of which I contribute to as well, answering a lot of these questions that you may be hearing being floated around in the market. Obviously, the Federal Reserve just met today for an example. So I just penned a note on what's the key takeaways from the Federal Reserve meeting, and as investors, how should we be repositioning the portfolio as a result of what came out of Fed policy today? That's the first resource. The second resource is www.chase.com/the-know. www.chase.com/the-know. This is a great resource. If you open up that page, they have a bar at the top of the page to the far right that says how to start investing. And it provides 7 steps on how to get you to the point where you feel comfortable to start making those investment decisions. So those are 2 resources that I wanted to share in terms of market knowledge and getting yourself a little bit more comfortable in what's going on with the world and how that might impact investment portfolios. The third link that I'd like to share is www.jpmorganwealthmanagement.com. That's www.jpmorganwealthmanagement.com. Now, this is another great site, a JP Morgan resource, and it allows you to gain access to the investment platforms that we have been talking about. Let's just say you want to start and work with a financial advisor. You can use that link to get in contact with a financial advisor. Let's just say you wanted to be more self-directed and you wanted to start making your own investments. We have a JP Morgan platform here that can allow you to get up to speed. Also, you may be surprised to find out we also have a robo advisor as well. So very much similar to an Acorns, a Betterment. These robo advisors really allow you to not do too much, get too fancy with your own allocations or making your own decisions. But generally speaking, if you are looking for a more conservative portfolio to a more aggressive portfolio, we've already curated a collection or a portfolio that really fits that need. And so again, we've got a lot of different resources that you all have access to and to pull from. And we're just very excited to continue to work with this group and helping to get invested, to build generational wealth, and to provide educational resources to listeners so they can feel confident in making these financial decisions. So with that, we've got about another 8 minutes or so. I'd love to open it up for some questions from the audience if there are any. So I see Delmar there. Please feel free to send over your questions as they come in. So we've got a question from Otis. How often should I check in with my financial advisor? Great question. It generally depends on the type of financial advice that you're looking for. Typically what happens is when you first sit down with a financial advisor, they're probably going to want to talk to you, at least once a month. They'll put a plan in place. They're going to want to look at, your overall balance sheet, your trust in estates, any type of insurance policies that you have. And they're going to want to work a little bit more kind of hands-on within the first couple of months to get you to a point where you're at where you feel comfortable with a long-term plan that's put in place. Those first couple of months, they're probably going to work on establishing your liquidity bucket, those 3 to 6 months in savings, your medium-term account, so sort of your 2 to 5 year plan, and then that long-term saving, which is probably going to be somewhere along like your retirement, or if you're investing or saving for your child's education, which is well down the road, that longer-term bucket. Typically thereafter, depending on your financial needs, advisors will typically send quarterly updates to their clients on how the overall portfolio is doing. In some instances, they may look to see, they may see some changes to either your spending patterns, and they'll reach out to you maybe more frequently. But typically, within the first 3 months or so, you're probably meeting more frequently. Once that plan is set in place, thereafter becomes probably more quarterly. How are financial advisors paid? Well, that varies depending on the entity that you use for your financial advisor. I'm not at liberty to say how JP Morgan advisors are paid or how Edward Jones advisors are paid, but typically in some cases it could be off of the overall assets under management that they work under. So let's just say an advisor has, say, 30 clients, and amongst those 30 clients, they manage 25 million in assets. They may get a small percentage of that 25 million. So that's one way advisors are compensated. In other instances, it's about how many accounts that they're bringing into the firm. There may be some sort of compensation tied to that. But again, there are varying ways in which a financial advisor are paid depending on the structure for which they work with. Any other questions? I'm monitoring the chat here. So one question that came in is, what should you major in to be an advisor? Great question. You really can be any major. I'll be very transparent. I work in market research, macroeconomy. I speak with financial advisors every day, and I'm an African American studies major. And I tend to see a lot of liberal arts majors that are financial advisors as well. So it's really about what you're interested in. Typically when you look at a lot of these companies, JP Morgan included, we're not necessarily so keen on your specific major per se. We just want to know that you have a genuine curiosity for markets. Now, with that said, for financial advisors, you tend to see a lot of financial advisors get credentials along the way. So whether they get their CFP, Chartered Financial Planner, whether they get their SEMA, which is another sort of tax planning exam, that certification that you can take as well. So there are a lot of certification that they tend to get along the way, but I would say there's no specific major that will help you set you up to become a financial advisor more so than another. So. All right, we got about 2 minutes left. We've got time for one more question or two. Give it about another 10 to 20 seconds, see if any come in. Well, again, we are just right about at the top of the hour. Really want to say thank you to all of you who joined us here this evening. Again, really appreciate your time. If you have any additional questions, please feel free to reach out to myself or reach out to Otis, and he can get in contact with me on any sort of questions. I will also highlight that all of the slides that were presented today are approved. So if you are interested in any of the slides, the guide to the markets, the guide to retirement, we're happy to send that material over to you as it's incline approved. So again, I really want to thank you again for all of your time. I enjoyed myself. Thank you for your questions. Thank you, Otis, for helping us set up. Thank you, Delmar, for all your support here today as well. And I hope we can do this again soon. Everyone have a great evening.